Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Atmus Filtration Technologies Inc. Annual Report. Atmus Filtration Technologies Inc. offers a wide range of filtration products and services under the FleetGuard brand. Their product line includes fuel filters, lube filters, air filters, crankcase ventilation systems, hydraulic filters, coolants, and other chemicals for various types of vehicles and equipment. The company's offerings cater to both on-highway commercial vehicles and off-highway agriculture, construction, mining, and power generation vehicles and equipment. Their filtration products are designed to meet the specific needs of these industries, ensuring optimal performance and efficiency. In addition to their product line, Atmus Filtration Technologies Inc. also provides service-related solutions, including remote digital diagnostic and prognostic platforms and analytics. These services enable customers to monitor and maintain their equipment more effectively, reducing downtime and increasing overall productivity. Atmus Filtration Technologies Inc. ATMU has experienced a remarkable surge in its stock price over the past year, with a 62.58% increase as of February 10, 2026. The company's strong financial performance and strategic moves have collectively contributed to this significant growth. One key factor behind Atmus' success is its robust fourth quarter and full year 2025 results, which exceeded analyst expectations. The company reported net sales of $447 million for the fourth quarter, a 9.8% increase from the prior year, and diluted earnings per share, EPS, of $2.50 for the full year 2025. This positive earnings report led to a pre-market stock rise of 3.59%. The acquisition of Koch Filter Corporation in January 2026 has also played a significant role in Atmus' growth. The strategic move aims to establish Atmus' presence in the industrial air filtration sector and expand its portfolio into high-growth end markets. Analyst upgrades, including J.P. Morgan's upgrade from neutral to overweight, have further contributed to investor confidence. In addition, Atmus has demonstrated a commitment to returning value to shareholders through its share repurchase program and dividend payments. The company also provided an optimistic outlook for 2026, projecting year-over-year growth of 10–14% in total sales. These forward-looking guidance likely fueled investor confidence in future growth. Overall, the combination of strong financial performance, strategic acquisition, analyst upgrades, and shareholder-friendly actions has propelled Atmus Filtration Technologies Inc.'s stock to new highs, resulting in a significant increase over the past year. Atmus Filtration Technologies Inc. maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Atmus Filtration Technologies Inc. trades at a higher price-to-earnings ratio of 26 times and a higher price-to-book ratio of 13.81 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, key contributors include strong relationships with leading OEMs, first-fit sales to original equipment manufacturers, and expansion into new markets such as industrial filtration. The company's ability to leverage its global footprint and technical capabilities has also opened up new opportunities for growth. Furthermore, the development of high-quality products that deliver value to customers, coupled with a diversified customer base across various industries, has contributed significantly to revenue growth. Additionally, strategic partnerships and acquisitions have driven accelerated growth and improved profitability. The company's experienced leadership team and direct connection with channel partners through distribution centers worldwide have also played a crucial role. On the other hand, factors contributing to revenue decline include loss of top OEM relationships, changes in end-user preferences, variability in material costs, interruptions in supply chains, and sales declines to key customers such as Cummins. These challenges highlight the importance of maintaining strong relationships with major customers and adapting to changing market conditions. The analysis of net income and profit margins reveals a mixed trend over the specified period. Initially, net income decreased from $185.6 million in 2024 to $171.3 million in 2023. However, this downward trend was short-lived, as it rebounded significantly to reach $207.4 million by 2025. Meanwhile, profit margins showed an upward trajectory. The gross margin increased from 26.6% in 2023 to 28.2% in 2025, indicating a notable improvement in the company's pricing power and operational efficiency. Similarly, the operating income margin rose from 15.2% in 2023 to 16.9% in 2025, signifying enhanced profitability despite increased costs. These changes suggest that the company has successfully navigated challenges and implemented strategies to boost its financial performance. The company's financial performance is a testament to its ability to generate positive operating cash flow, a crucial indicator of a company's financial health. Over the past 3 years, the company has consistently demonstrated a strong capacity for generating operating cash flow. In 2025, the company generated $202.7 million in operating cash flow, a significant increase from previous years. This trend is also evident in 2024 and 2023, where the company recorded operating cash flows of $105.4 million and $189 million respectively. These positive results indicate that the company's operations are generating sufficient cash to meet its financial obligations. The consistent generation of positive operating cash flow over the past 3 years suggests a stable and profitable business model. This is a key indicator of a company's ability to sustain itself in the long term, making it an attractive investment opportunity for potential stakeholders. The company's debt level has undergone significant changes over the past few years. Initially, the total debt capacity increased from $1 billion to $1.5 billion, indicating a substantial expansion of the company's borrowing capabilities. However, this increase was followed by a decrease in debt levels, with the amount decreasing from $592.5 million in 2024 to $570 million in 2025. In terms of interest expenses, there has been a notable decline. The interest expense decreased by $7.2 million, 17.8%, and also showed a significant net change of minus $7,900,000 from 2023 to 2025. This reduction in interest expenses suggests that the company is benefiting from lower borrowing costs or more efficient debt management strategies. Overall, while the company's debt level has fluctuated over time, there are signs of improvement in its financial health, particularly with regards to interest expenses. The company's performance was mixed across various regions and segments. Regions with potential issues include China, Russia, Mexico, Canada, and EU-Russia relations due to export controls, sanctions, and trade restrictions. On the other hand, some regions were not listed as having potential issues, suggesting they performed relatively well. In terms of revenue by product category, fuel sales increased from $705.2 million to $797.6 million, while lube sales also saw an increase from $305.4 million to $348.8 million. However, air sales remained stable, and other categories experienced a decline in revenue. Major customers also showed varying performance. Cummins increased its market share from 17.4% to 18.8%, while Traton Group decreased its share from 12.2% to 11.5%. PACCAR's market share was relatively stable with a slight decrease from 16.5% to 16.3%. The company's equity, royalty, and interest income from investees also showed mixed results. Shanghai Fleetguard Filter Co. Limited saw a slight increase in revenue, while Fleetguard Filters Pvt. Limited experienced a slight decline. Filtrum Fiber Technologies Pvt. Limited's revenue remained relatively stable with a slight decrease. Management's outlook for the company is one of strategic growth and adaptation. They are investing in future technologies and products to meet increasing demands globally, while also diversifying into new markets through joint ventures. This expansion will not only increase market penetration, but also reduce capital spending and streamline supply chain management. A key component of this strategy is the acquisition of Koch Filter Corporation for $450 million, which will provide a substantial platform for expanding into the industrial air filtration market. Furthermore, management is focusing on product improvements, extensions, innovations, and cost reductions to meet customer needs. The company's future growth also depends on adapting to global technology trends and addressing customer needs. By diversifying its product offerings across industries and application types, the company aims to mitigate risks associated with technological transitions. Overall, management's strategy is centered around innovation, expansion, and risk mitigation, positioning the company for long-term success. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, one notable example is the purchase of a business in the industrial filtration market in 2026. Additionally, the company has also made prior acquisitions that have contributed to goodwill amounting to approximately $84.7 million as of December 31, 2025. On the other hand, the company has also engaged in divestitures, which involve the sale or separation of non-strategic business lines. One such example is the separation from Cummins, a process that resulted in one-time separation costs and capital expenditures totaling $25 million. The separation agreement also specified that certain assets and liabilities would be retained by Cummins. The company's financial activities have been multifaceted. One notable aspect is its dividend payment history. As per the provided information, the company has consistently paid dividends across various pages, indicating a commitment to rewarding shareholders through regular distributions. In addition to paying dividends, the company has also engaged in share buybacks. This strategic move demonstrates the company's confidence in its financials and its desire to return value to shareholders by reducing the outstanding share count. The fact that share buybacks are mentioned across multiple pages suggests a deliberate effort to repurchase shares, further solidifying the company's commitment to shareholder value creation. Concerns about inventory buildup or supply chain disruption are evident throughout various pages of the report. One of the primary concerns is the potential for interruptions in the supply of critical materials and components, which can lead to manufacturing disruptions at multiple locations. This risk is further exacerbated by long lead times due to complex manufacturing operations, making it challenging to adjust production capacity in response to changes in demand. The complexity of supply chains and manufacturing processes also poses a significant threat to supply chain resilience. The report highlights the potential for labor disputes, work stoppages, and delays in suppliers' deliveries, which can have far-reaching consequences on product quality, warranty, and safety issues. Additionally, exposure to fluctuations in demand due to unforeseen events such as natural disasters, cyberattacks, or pandemics further increases the vulnerability of supply chains. The report also notes that inventory buildup is a concern, with total inventories increasing from 2024 to 2025. This suggests that there may be issues with inventory management, which can lead to wasted resources and decreased efficiency. Furthermore, unfavorable logistics and duties costs have increased by $36.2 million, 2025 versus 2024, indicating potential vulnerability to supply chain disruptions. Overall, the report highlights several concerns related to inventory buildup and supply chain disruption, emphasizing the need for improved supply chain resilience and more effective inventory management strategies. That concludes the financial summary for Atmus Filtration Technologies Inc. Feel free to comment below, and I will be happy to answer them when possible.